Hi guys, welcome to the second video of this channel, and today we're going to be talking about what is investment banking, because if you watched the previous video already, we know what we're going to be touching on, all of the different concepts, and this is, like I said once again, a zero to hero course, and we're going to be learning everything from what it is, what you're going to be doing as an analyst, all the way up to like an MD, what your roles are, what your everyday tasks are going to be, to kind of how the entire process is structured, what kind of groups there are, product groups, coverage groups. Um, yeah, so we can get straight into it. Let me change this to text. So, um, to start it off, I feel like before any like technical concepts in accounting, valuation, it's important to know what these guys actually do. So what these firms sell, who does the work, and like how a deal happens. So what does an investment bank do? An investment bank is an advisory, not is, but provides an advisory service. And by this, we could talk about it basically does two big things. It helps companies raise money, buy slash sell businesses, and this is what M&A is, mergers and acquisitions. So merging two companies together or one company acquiring another company. So that's kind of the main thing that these guys do. You guys can forget about like the pitch books, the late nights, all everything for now. We're just going to be touching on kind of what these guys do, and let's just think about it in like a plain English sort of way. They're kind of just like a real estate agent for companies. When you sell a house, for example, you kind of hire an agent because they know the market, they know the buyers, they handle your paperwork, and they negotiate with the seller or the buyer for a better price. And in this case, the bank basically does the same thing. An investment bank does the same thing. The house is basically the whole company worth billions of dollars, and the agent earns a fee from closing the sale. So, like I said, how do these companies invest, how do these investment banks, sorry, how do these investment banks make money? Investment banks make a fee, like I said. So, say company A acquires company B, and company A reached out to our investment bank for help. Basically, say that the deal is like $100 million deal, they take a certain percentage of a fee, and that's how you make your money as an investment bank. And basically, investment banks offer two core products, and let's split this up. Like I said, it's an advisory service, but it also splits up into two main things. So let's break this down. So let me split this up right here with the line. Sorry, that's a terrible line. Okay, and let's put our first thing here, capital raising. And right here, oh shoot, this is in the way. Sorry about that. We can honestly delete this for now. And if you want to go back and look at that, you can feel free to go ahead too. But we have capital raising here. And right here, we have your advisory. And this is your M&A stuff. So let's bullet point some of these things down. So within investment banking, you have multiple groups, I'd say. So you have your equity capital markets group, your ECM team, you have your debt capital markets group, your DCM team, you have your M&A group, the most, I feel like everyone just chases after it because that's the one you get that pays a lot, that pays the most actually, and has the best exit opportunities. But it's also requires the most work and most time in most of these. But there's also a bunch of other ones like restructuring, um, and with an investment bank, you also have equity research groups, you have your sales and trading groups, and I'll go a little bit more into depth on all of those right in a couple of minutes. But let's just talk about what these guys do, right? So you have your capital raising and you have your advisory. Number one, in this, we have your ECM team, and this is equity capital markets. ECM. So honestly, I think it's better if I just delete this as a whole and just start typing this out. So let's start with your capital. Sorry if it's super unorganized. I'm just going off the top of my head. It's one of my first YouTube videos that I made. So capital raising, you have your ECM, equity, capital markets. You may be asking what these guys do. So let's talk about it. So in this, a company basically sells ownership, equity. Equity is basically a percent or a share in a company. So for example, the company sells ownership to someone else, a piece of its company to someone else. And the first time this basically happens is you may have seen, for example, recently SpaceX IPO'd. What is an IPO? It's an initial public offering. And these companies are basically opening up their shares for anyone and everyone to kind of just go ahead and buy and trade. So this is an initial public offering, and investors get shares and the company gets cash and basically never pays it back. So in this case, an ECM team would help a company, for example, like SpaceX, to go ahead with their IPO, how to distribute their shares, how all that stuff works with their equity thing. I'm not a huge, I haven't dived deep super that much into ECM, but that's basically just all you need to know. If you want to go deeper into ECM, say you want to apply to an ECM team, for example, at BOFA or another bulge bracket bank or another bank, I'll be making an entire series on specific stuff for questions on M&A, ECM, DCM, restructuring, specific questions they would ask you, whether you're doing like leverage finance, whatever. But your next team is DCM, debt capital markets. And this is the first time you're going to start seeing a pattern here, because in finance, the biggest thing that you got to know is that when you raise money for any business, you either do it through two ways. You can either do it through equity or you can do it through debt. Either you offer a percent of your business to someone, right? You can offer a percent, you can offer like 30% of your company for an investor to put in X million amount of dollars or how much ever, so your company can grow with that capital. Or you take out a loan from a lender and you can take on that debt. But here in this case, it's a little different because these two are teams that kind of specialize in equity or specialize in debt. And basically here the company borrows, like I said, because borrows debt, when you're selling ownership, you're kind of dealing with equity. So here the company borrows, it sells specifically bonds. So bonds is kind of the big thing here. They deal with a lot of bonds, and these guys they promise to pay interest and they repay money later. This repay money later. Right? If I can get this out of the way, that'd be nice. But okay, let me just. Yeah. So that's basically your two groups here for capital raising. That's your main two groups. Then you got your advisory groups or your M&A. So this is basically split up into two things. You have your sell side and then you have your buy side. Buy side is typically regarded as more prestigious because you're doing a lot more I guess there's a lot more deal knowledge that you get to learn on that end when you're typically buying a company rather than just selling it, because there's a lot more. And we'll be talking about how each of these specific processes work as well. So in the sell side, basically it's pretty straightforward, just how the name goes. What a merger is a company's merging together into one. For example, Whole Foods and Amazon, for example. An acquisition is a company buying out another company. So in a sell side, the situation would be company A is selling a subsidiary, like another one of its companies, or its own company to company B. And how this process works on a super high level is it runs an auction, they find the buyers, and it just pushes the price up, and they just sell it to the buyer who is the best fit for this company. And we're going to be talking about how it's specifically done in this video itself. So don't worry. This is just saying what these guys basically do. On the buy side, company A is trying to buy company B. That's basically all it is. And you can talk about the specifics a little later, but that's all you got to know for, I guess, the sell side and buy side for M&A. And I feel like it's also important to be a little careful because these words have a second meaning, and the interviewers kind of, in my opinion, from what I've seen, they like to mix up if you do tend to mix it up because above sell side and buy side is described kind of who the bank represents in one deal. In the wider industry, the same word split the whole finance world into two halves. So, for example, this is specific to investment banking, but if you say were to go out a little more, a sell side a sell side finance firm would particularly be banks, brokers, and market makers. And these guys are like these firms kind of create and sell financial products and services, and like these investment banks are mostly sell side. Then you have your buy side. Buy side are typically these private equity funds, private equity funds and firms that kind of buy out other companies to restructure them and sell them at a higher price. So you have your private equity, your hedge funds, and pension funds. That's what you're on the broader scale. So you got to be a little careful. This is specific to investment banking, and this is just the general finance area. So let's delete this for now. If you want to go back, please go ahead and feel free to. But right now, we're going to be talking about what type of banks there are. So you have your bulge bracket, then you have your elite boutiques, then you have your middle market. So you may be wondering what these guys are, and I'll tell them. I'll break it down a little further. So let's talk about bulge bracket. Bulge brackets are your big name brands like Bank of America, JP Morgan, um, who else? Just common banks like um, UBS. These are kind of your bulge brackets. They have a lot more. They have all variety of deal flow coming through. They're not super specialized, and these guys are kind of huge global banks that do everything, whether it's advisory, trading, capital raising, lending, wealth management, and they serve like the largest companies and handle the more massive volume. And just I'd say if you want to like think about them in a specific way, you can just think of them as like full service department stores in the world of finance. If you're talking about your elite boutiques, so let's just talk about like pay structure here as well, right? So your bulge brackets would pay you a decent amount, I'd say, but it kind of goes you get paid the most in elite boutique, then a bulge bracket, then a middle market. But right now the job market, especially for investment banking, is so competitive that even breaking into a middle market is pretty difficult if you even know all the stuff because at the end of the day, it's three main things that factor in: networking, your technicals, and also your behaviorals. Just because people want to work with people who like they could spend like those long hour weeks that everyone knows of, like 90 to 100-hour weeks that they could sit with a banker and be like, just catch up or just talk to them like with a real person, not like some bot. So we have your elite boutiques, right? These guys are your smaller firms, and actually instead of here I wrote out, for example, you have these are your um, big names that are already pretty well known. You have your Evercore, you have your Moelis, you have your Lazard, Centerview, who else? Catalyst. So who are these guys? These guys are kind of your smaller firms focused only on advisory. They don't do the trading stuff. They don't do equity research and all that. Sure, they might have like they may use it, but they specialize in advisory. So they don't have these big trading floors like BofA does or JP Morgan does. They sell advice, judgment, and like they have these senior banking relationships because they do not lend or trade. They kind of carry fewer conflicts of interest. So some boards trust them on more bigger and sensitive deals, very specialized stuff. So I guess for let's just say Evercore, they're very no they're strongly known for their strong M&A and restructuring practice. So these guys are very specialized. And when you come to middle market, I feel like it's a name speaks for itself. I can't really name a couple on the top of my head because there's so many middle market but we can just type out what they are. These banks kind of just serve, I guess, small and mid-sized companies, and the deals are often below $1 billion. They still get high volume, steady work, but I'd say it's obviously less than your big name brands and your elite boutiques that I've mentioned here. So yeah, that's kind of just what it is for just splits up into three main things when it comes to recruiting. I'd say you can easily go from middle market to bulge bracket to elite boutiques, or you can jump from bulge bracket to elite boutiques. I've even seen some people just jump straight into an elite boutique, but at the end of the day, investment banking is investment bank. I feel like cloud chasing, especially for these name brands, has become huge, but at the end of the day, you guys are doing the same stuff, and it's just great knowledge. And now, since we've covered this, let's talk about how a investment bank is organized. Let's talk about the organization. So here you kind of have number one, you have your coverage groups. So in your coverage groups, this is kind of industry. And in your coverage groups, you have your tech, um, healthcare, energy. I currently go to UT Austin, so I know a bunch of people who've actually broken into specifically the energy cover group because energy in Houston is huge. And some of these banks, their energy sector specifically focuses on Texas, and they come here to recruit for that. So that's pretty big. Energy, financials, um, or consumer and retail. And all of us probably have seen the TMT from the TMT from Goldman. That's pretty popular. What this is kind of their technology, media, and telecom group, and that's what they're kind of known for. So this is your coverage group, and I'll talk about what these are. So then you have your product group. So this is kind of deal type because these are all industries, and these are kind of like the deal types that are focused on M&A, RX, or this is just restructuring. This is And then you have your ECM, DCM, and leverage finance. Okay, so number one, your coverage groups. These are kind of your bankers who know one industry cold and kind of own the client relationship because they specialize in, for example, a banker is just specifically focusing on tech banking or energy or whatever it is. They have a very specific um, knowledge that's tailored to that specific group. But your product groups, these guys are kind of plug and play. Like you can drop them into anywhere, and they know the transaction, the type of transaction, super cold, and they can be plugged into any industry. So yeah, that's basically it. Super simple stuff. And now let's get down to your how this entire hierarchy works. Because once again, you may already know this. You can probably skip this video if you feel like, oh, this is super repetitive. I already know this stuff. Please go ahead. But this is just for people who don't even know what investment banking is and just getting started off. So let's just say this is how kind of the career progression works. So you have your 0 to 3 years as for example, you start off as an analyst. You're kind of building your models, the pitch books, you're doing your research, whatever. Maybe like one of your slides gets put into the the pitch deck that they show to a company or something. That's what you're doing as an analyst. Then I guess you're 3 to 6, you're going into your associate role. Associate, they kind of just check the analyst work and just manage the models in the deck. And then from here, you go into your 6 to 10 years. You have your VP. Your VP guys are kind of the guys who run the deals day to day. They manage the analysts and the associates. And then let's just, so I guess VP 6 to 10 years. And maybe usually people in the associate place transition out into private equity, private credit, or an hedge fund, for example. But if you just continue to move up the ladder, you're going to go into your director or senior VP role. And this is kind of just your senior deal captain. And they're just groomed to win businesses like an MD. They're super similar. So you have your 10 to 15 years. And then when you reach your 15 plus years mark, I'd say you'd be in that MD range. They own client relationships. You're going out to client dinners, managing these relationships, and you bring in those fees for your bank. So that's kind of how this structure works right here. And let's talk about how a deal actually happens. Because I'll talk about, for example, we'll just talk about a sell side. I'll talk about a buy side as well. So here's like a sell side process from like start to finish. A company hires your bank to sell it, and let's just say you run this play. So let's start off with the prep. This is just how this would work. So your prep, number one is your prep. So your bank basically studies the company, builds the model, and writes like the marketing documents, a short teaser, and a detailed sim. A sim is basically, I'll just write this out. A sim is basically a confidential information memorandum that's kind of like a little bit like some information about the company itself when presenting it to people who want to buy that company. Next, you're going to be contacting your buyers. That's your next step. So the bank kind of reaches out to a list of likely buyers, sends the teaser, gets interested parties to kind of sign an NDA. An NDA is a non-disclosure agreement, which basically says the stuff is super confidential. You can't be spoken about. Um, and this is only for your eyes, I guess. And they, first of all, before preparing this, before sending the sim over, they send over the NDA, so they sign that before they can see like what the company's all about. So I guess they prepare the sim first. They contact the buyers. They the the buyers sign the NDA. Then they send the sim. Next, you have your first round bids. So you have your first round bids, and then these guys are basically like these buyers send in, I guess, non-binding offers, and the seller kind of just picks a short list to move forward. So they have a bunch of buyers, and based on whoever the seller seems is a great fit to kind of either run the company from a leadership standpoint, or whoever's bringing in the most capital for that, whoever making it really appetizing for that seller. I guess that's kind of where that is, and the seller kind of shortlists the person there. So shortlist here, and then you do your due diligence. So the shortlisted buyers kind of dig into the details and whether it's a data room or they do a meat management or a pressure test before every number that they commit. So they do their due diligence, make sure everything is all good to go. And number five, I'd say, if I'm remembering this right, it's the final bids and kind of like the negotiation. So once these bids are placed, the buyers submit like binding offers now because originally the first round bids were non-binding offers. The final bids are binding offers, and they kind of talk about like the markup of a purchase agreement, and the seller, right? The seller negotiates the price and terms with the front runners. So that's basically what happens here. You kind of the seller's negotiating prices. You're getting in your final bids and they're binding. So if the seller does decide to choose you as a buyer, you're going to be having to put that capital up front. And then lastly, you sign and close. So this is where both sides sign the deal after approvals from like the regulators and shareholders, and the money moves and the deal closes. And usually this process runs, from what I know, 6 months or longer. And if you're an analyst in M&A, you're going to be dealing with this, I guess, day to day, this entire process. You're just going to be iterating through it continuously. So that's basically how your sell side is, how an auction works in the sell side. And now I guess let's talk about buy side. You have your buy side here, right? So the process above was sell side auction, where your bank markets a company to many buyers and drives the price up. A buy side engagement kind of just flips the roles. N- now one buyer kind of hires your bank to help them acquire a specific target. And now you're not kind of running an auction, you're helping your client win the right asset at the right price before without kind of overpaying. Because at the end of the day, you want the best for your client. And say that they want to buy a company, they want to get it at the best price possible and to have that competitive advantage. So number one, you have your strategy and screening. And a lot of these private equity firms will deal with buy side because they are buying companies. So they'll be involved in this process a lot more. So a buy side, so you have your strategy and screening. That's your first step. So here the bank kind of works with the client to define what a good target looks like what they're looking for, anything that any specifications, they may provide a tier sheet, whatever, then kind of builds a list of candidates that fit the strategy, the budget, and whatever the buyer's culture is. So that's their number one. And then number two, you have um let's write this down. So here you have your approach the target. So here the bank kind of makes contact, gauges willingness to sell, and if the target kind of runs its own auction, then it positions the clients to compete. So here you're like similar to sell side, you're just gauging like the willingness, seeing if people are willing to either buy or sell, like similar to the sell side, and they just run their own auction, just see what's up. Pretty simple. Then you have your valuation and diligence. So here, valuation and diligence, the bank kind of values the target, seeing how much the company A wants to buy company B, seeing how much that company B is worth through valuation, how the deal affects the buyer and kind of digs into the risks. The goal is kind of like at the end of the day for valuation and diligence is a price that wins without destroying the company's value. So that's super important. Number four, you're coming to your financing and structure, right? So the bank kind of here helps decide how to pay, whether it's cash, stock, debt, or a mix. It could be a mix of them, and lines up the financing if the client needs to borrow, if they need to leverage equity, if they need to leverage debt, whatever it is that comes in the financing aspect of the buy side process. And lastly, as all the last steps are, they negotiate, sign, and close. So the bank kind of just negotiates price and terms. They sign the agreement, and they close after like the regulators and the shareholder just approves. So that's kind of like the process at a very high level. We're going to be talking about all this in the M&A chapter a lot more. So that's kind of just how this works on a sell side, buy side, the process. And like say someone asks you like would you rather run a sell side or a buy side deal, there's no wrong answer in my opinion, but I feel like you should just understand the difference. You should show that you understand the difference by listing out how this process works. Sell side basically means controlling a process and creating competition. Buy side is more just judgment and protecting your client from overpaying, because I feel like in these interviews bankers at the end of the day respect a candidate who sees both sides really clearly, and that's super important. So nowadays, say a company's going bankrupt, there's going to be a group known as, I think we already talked about this, but we haven't talked about what they do. Your restructuring group. So you have your restructuring group, and in this restructuring group, sorry, 1 minute. So in your restructuring group, the kind of bank that's known for this is Evercore, and I feel like that's the best bank to use as an example as well. Evercore kind of runs like one of the best restructuring practices on the street. So usually in the industry, they shorten restructuring to RX. It's basically advisory for companies that are in financial trouble, like I said, bankruptcy. When a company has too much debt and cannot pay, these bankers kind of step in to fix the balance sheet. So here they kind of hire two advisors. You have your two advisors. You have your debtor side, and these guys kind of advise the struggling company at hand. Then you also have your creditor side that kind of advises the lenders who are owed money. That's basically what this is. You have your two advisors in restructuring, and kind of both want the best recovery from a bad situation. The work can happen out of a court through negotiation or whatever, but that's basically how restructuring works. It's and also something super cool to touch on is restructuring is counter cyclical. I actually learned about this pretty recently, but like for example, when M&A booms and when like the economy is strong and I guess the mood is good, restructuring booms when the economy is weak and companies are falling, because M&A in this case is dealing with companies buying and acquiring, merging. This is basically signaling that an economy is strong. Say that the economy is at a bad time, what is a bank going to do? They're going to focus more on your restructuring deals. So these restructuring booms really happen when the economy is weak. So a firm strong in both, for example, like Evercore earns fees in good times and bad. And what I recently learned as well, like I said, was the counter-cyclical part, because I've always thought about it in a separate way, but these kind of things go hand in hand together. So M&A and RX are just counter-cyclical. And say someone asks you why, in this case, like we use as an example, Evercore, a strong answer kind of ties in together like the independent advisory model, the elite M&A reputation, and also their restructuring process that kind of keeps the firm busy across the whole economic cycle. And yeah, that's basically it for chapter one. And we can just wrap it up with a few practice questions here just to see if you know your stuff. So I guess, what are the two core things an investment bank does, right? So what are your two core things that investment banking does? If you want to take the time to pause this video, please go ahead. Okay, so your two core things, we talked about this. They help companies raise money, which is through either debt or equity, right? Then you have your next thing, which is your advisory, which is your M&A, um, buying or selling companies, right? So that's there. And let's just say now we also learned about the elite boutiques, your bulge bracket, your middle markets. Um, let's just say, what is an elite boutique and why does its model earn client trust more? Take the time to pause the video. Okay, so here an elite, because just no one's going to ask you what an elite boutique is, because if you're applying to one, they're not going to really ask you, but it's good to know this in case you want to leverage something into your interview answer or something. But an elite boutique kind of is a specifically an advisory firm. They don't deal with trading, they don't deal with equity research, they don't do have these big trading floors. They're just specifically advisory. They don't lend. It kind of carries fewer conflicts of interest. So borrows its advice on, I guess, sensitive deals. So yeah, so that's kind of what that is. And let's just next question. We can let me think. Um, why is a firm with both M&A and restructuring more stable through the cycle? We just talked about this. Take the time to pause this. But basically, M&A, good economy, it's doing great when there's a good economy. Restructuring, bad economy. In both of these, you're earning fees. So either ways, it's going to be profitable for the bank. So we'll end it off with one last question. So walk me through a sell side process. So this is how I would say, I guess, let me formulate my thoughts. If I were to say, if someone asked me, walk me through a sell side process, I'd be like, okay, so I'd first prepare the model and the marketing documents, contact the buyer and under the NDAs, collect the first round bids, run the due diligence with a short list. Then after that, I'd take final binding bids and negotiate, then sign and close after approvals. Super high level. It's all you need to know for a lot of these banks. If you're going super into depth, we'll make it deeper answers talking about what kind of documents you're sending, whether it's the SIM or an information memorandum or whatever it is. So this is kind of just a basic things just to see if you're understanding what we've been talking about so far. And I apologize if I'm not teaching properly. It's my first time teaching this kind of concepts, but I just decided it would be something super helpful for people to just learn. And yeah, I'll see you in the second chapter. We're going to be talking about the foundations of finance, and we'll wrap this video up here. Thank you.